Hi, this is David from Naked Investors. What do you do with your hard-earned money? Where do you keep it so you'll have it later when you need it, such as when you retire? Ideally, you want to keep your money safe and make more of it. To do this, you have a range of options, which I call the hierarchy. First of all, you need some money to walk around. Keep money in your pocket or your wallet, and then a little bit extra at home, say in the sugar bowl or under your mattress. Your money is close by where you can get it for sudden emergencies. When the toilet is backed up on Friday night and the plumber only accepts cash and you can't get to the ATM, you'll be glad to have some money stashed away at home. But there are risks. Burglars always look under the mattress. Your house can catch on fire, or your stash of cash can be devoured by bedbugs, or inflation. In fact, the effect of inflation guarantees that you will lose your purchasing power. You can keep some money in the bank. This is a good place for larger sums. The money is safe and sound. It's even insured. You can get it from the ATM or write checks. And the bank might even pay interest, though probably not enough to keep up with inflation. Inflation will guarantee that you will lose money over time, but the bank is a good place to accumulate and store your money beyond what you need for short-term expenses. Be sure to sweep some money from your savings account to your online trading account regularly. Then there are treasuries. Everybody has treasuries, even governments. Japan, China, Saudi Arabia, Germany, and you can too. Treasuries are bonds sold by the U.S. government. The interest is higher than what the bank pays, and usually higher than the rate of inflation. It's probably the world's safest investment. You can go with corporate bonds. When a company borrows money, it pays a higher interest than Uncle Sam, but there is a greater risk that a company may default. Even huge, successful companies can go bankrupt. General Motors and United Airlines both filed for bankruptcy and recovered, but some big companies, such as Enron, Global Crossing, and Lehman Brothers, simply go bust and take your money with them. Funds. You can invest in a fund that in turn invests in the stock of a lot of different companies. Examples include mutual funds, exchange-traded funds or ETFs, and index funds. Most funds perform just below the market over the long run, but an index fund that matches the market, such as an S&P 500 index fund or a total market fund, is a wonderful investment recommended by Warren Buffett himself. The S&P 500 index fund is 500 of the largest public companies listed on the New York Stock Exchange and NASDAQ. When we talk about the U.S. stock market, it means every publicly traded company in the U.S. That's a lot of companies, some huge and some too small to bother with. By taking the top 500, we get a very accurate approximation of the entire U.S. market. The S&P 500 essentially is the U.S. market and is widely used as a benchmark. By investing in an S&P index fund, you are buying and owning a piece of the American economy. You can expect an average annual return of just about 10%, with virtually no risk in the long term. For many investors, an S&P index fund should be the main holding in your portfolio. For smaller investors, it may be the only holding. What if you'd like to buy particular stocks? A good place to start would be Berkshire Hathaway. Maybe you'd like to juice up your returns beyond the 10% you can expect from an S&P fund. You can let Warren Buffett and his team work their magic for you. They have been earning a compounded annual gain of almost 20% from 1965 through the present, effectively doubling the S&P. You can easily do this by buying shares of his company, Berkshire Hathaway. The A-class shares are beyond the reach of most investors at the astronomical price of over $200,000 per share, but the B-class shares, which I affectionately refer to as Berkey B, are at a more affordable 145 or so as of this year. A portfolio consisting of some combination of the S&P 500 and Berkey B should continue to yield a healthy return with practically zero risk in the long term. Of course, there is no guarantee that Berkshire will continue to appreciate at its historic rate. As the well-known disclaimer goes, past performance is not an indication of future performance. What if you'd like to get a little more adventurous? There's trading. Now we're starting to see some risk. Trading means buying and selling stocks in the short term in the hope of beating the market. This is very difficult to do consistently, and most professional fund managers fail to do it. Let me repeat that because it's critical. Most professional fund managers fail to beat the market. Still, most of us think we can be among the few to beat the market, and we like to give it a try. There's nothing wrong with this, provided you limit the portion of funds you devote to this hobby. There are lots of tools and systems available to help you, but remember that most traders will fail. Then there's speculating. Trading involves some discipline and rigor in attempting to identify winning stocks. Speculating lacks the rigor and consists mostly of acting on tips and hoping you'll get lucky. Most of the time, you won't. Then there's Vegas. Gambling is just one step beyond speculating. You don't want to bet the rent on a hand of blackjack. The odds of winning are slim, so decide on a sum that you can afford to lose and don't risk any more than that. What happens in Vegas stays in Vegas, including your money. All kidding aside, I am not suggesting gambling as an investment strategy. It is simply the most extreme point on the hierarchy. Using Vegas as one extreme of the hierarchy helps put things in perspective. Some gamblers win. A few win big, but most lose. Someone always wins the lottery, but it probably won't be you. The casino always wins, but not on every bet. It's a numbers game, so don't gamble, bet on the house. The market is the house. It always wins. Not every day, but over time. And the odds are better for the market than for the casino. A typical game at the casino has a probability of the house winning of just over 50%. But the market goes up over 70% of the time. Invest in the market, and you are the house. So there you have it, the hierarchy. Make sure you've got the basics covered first. Be very careful before considering the more risky options such as trading, speculating, and Vegas, and keep a long-term perspective. When your investing is right, you can sleep well at night.